Commercial real estate doesn't usually collapse with one dramatic moment. It weakens through refinancing. Because most commercial properties aren't paid off, they're financed. And that financing has a clock. Every few years, loans mature. And the owner has to refinance. In a low-rate world, refinancing is routine. In a high-rate world, refinancing becomes a wall. That's what's happening now. Not because every building is empty. Not because every landlord is reckless. But because the math changed, rates went up, credit tightened, property values adjusted. And the refinancing cycle is now forcing reality into the open. This is the commercial real estate reset. And the key mechanism is simple. If your loan resets at a higher rate, your cash flow must support that higher payment. If it can't, you have three options. Bring in new equity, sell the property, or hand the keys back. That's the wall. Now, why does commercial real estate matter? Because it connects to three parts of the economy: banks, business investment, and local government budgets. If refinancing stress spreads, it can tighten lending, reduce construction, and weaken local tax bases. So even if you never own a commercial building, the second-order effects matter. Let's break down what makes this cycle different. Commercial real estate loans often have shorter maturities than residential mortgages. A common structure is a 5-year or 7-year loan, sometimes with interest-only periods, sometimes with balloon payments. That means a large portion of the market must refinance regularly, and if the market environment changes, the risk shows up quickly. In the low-rate era, properties were priced with cheap financing. Owners could accept lower yields because debt was cheap. Now debt isn't cheap. So the same property must produce higher income to justify the same price. And in many cases, income isn't rising fast enough. So values adjust downward. Here's where the refinancing wall forms. When values fall, lenders won't refinance at the same loan size. They refinance based on today's value and today's underwriting standards. So owners face a gap. They need to bring in equity to cover the difference. If they can't refinance. And if they can't refinance, the property enters distress. That's the wall. Now, what types of properties are most exposed? Office is the headline category. Because occupancy patterns changed. Hybrid work reduced demand in many cities. Lease terms are long, so the pain shows up slowly. But as leases roll, vacancies rise, incentives rise, and cash flow weakens. So office faces two pressures at once: weaker demand and higher refinancing costs. But office isn't the only category. Retail has already been through stress, but certain segments remain fragile. Multifamily can face pressure where rent growth slows and expenses rise. Industrial is stronger in many markets, but it's not immune to refinancing math. And the key point is that even good properties can face stress if financing resets hard enough. Because commercial real estate is a leveraged asset class. Leverage amplifies both gains and losses. Now, why are banks at the center of this? Because banks hold large amounts of commercial real estate exposure. Not always the largest towers, often the regional and local exposures. Small offices, strip centers, local multifamily, industrial warehouses, mixed-use properties. These loans sit on balance sheets, and if values fall, risk rises. So even if defaults remain manageable, banks may tighten lending. They become defensive. They lend less. They require more equity. They raise standards. That's how commercial real estate stress spreads into the real economy, through credit. Now, there's a reason you don't see immediate mass default headlines, because the system often tries to delay recognition. This is the extend and pretend phase. Lenders extend maturities. They restructure terms. They avoid forcing a sale. Owners try to wait out the cycle, but extend and pretend has limits. It works if rates fall and values recover. It fails if high rates persist and cash flows weaken, because eventually the loan matures. Eventually the capital stack must reset. Eventually the property is repriced. So the key question is not, is commercial real estate crashing today? The key question is, how big is the refinancing wall and how long does it last? Now, what should you watch to track this? First, loan maturity schedules. When large volumes of debt mature in a high-rate environment, stress rises. Second, cap rates and transaction volume. If transactions freeze, price discovery stops. And price discovery is what resets the market. Low volume can delay the reset, but it also creates uncertainty. Third, bank lending standards. If banks tighten, refinancing becomes harder. Fourth, distress signals like rising delinquency rates in specific segments. And fifth, policy responses. Sometimes governments and regulators create programs to reduce stress. But those programs can only soften the timeline, they can't change the math. So what happens next? In many markets, the outcome is a multi-year reset. Values adjust down. Some owners recapitalize, some sell at discounts, some default, and lenders take losses over time, not all at once. Commercial real estate tends to move slowly, but slow doesn't mean safe. Slow means the stress can persist. Now here's the bigger macro story. A commercial real estate reset can tighten credit broadly. Banks with losses become cautious. Private credit can fill some gaps, but at higher prices. Construction slows. Renovations slow. Local spending slows. And local governments can feel pressure if property taxes weaken, so the refinancing wall isn't just a real estate story. It's a credit story. And credit is the oxygen of the economy. If credit tightens, growth slows. That's the channel. So here's the takeaway. Commercial real estate isn't collapsing because every building is empty. It's resetting because financing conditions changed. Higher rates created a refinancing wall. And refinancing walls force repricing. That repricing can spill into banks and the broader credit system. So if you want to track the real risk, don't only watch vacancy headlines. Watch refinancing conditions. Watch bank standards. Watch transaction volume. Because the reset doesn't arrive as one headline. It arrives as a slow, forced recalculation.